Hello everybody, my name is Emma Sansom and I head up the captive service team for Zurich in the UK. I deal with lots of different types of captives coming into the London market to place their international business, and we traditionally have worked with some of the larger companies who've got very well established single parent captives, but more and more we're seeing customers interested in protected cells and just generally in captives and different types of risk management, alternative risk management. So today I'm going to be talking to you about captives in international programs, and I'm going to talk to you a little bit about sort of some of the captive structures that you might see, something about the front end and a little bit about the back end, and then Zurich's approach to pricing and structuring the deals. So there will be hopefully time for some questions, and then I will be handing over to Peter Child, who's going to be talking about governance. So, good start. So, I think I'll just start off by saying that there's no real right way of structuring an international programme. There's certainly a wrong way from a compliance perspective, and I'll touch on that a little bit later. But the structure of an international programme and how you slot your captive into that is really determined by the needs of the organisation. It can enhance and optimise your existing captive, so your existing global fronting programme, but it also, by having your captive in there, can create an adaptable and flexible solution for your business as its risks change and the economy changes and the environment changes. So behind me, I'm just going to check the pointer out, see if it works. Behind me, this is kind of a typical approach to how you would structure your risk retention. You've got the working and maintenance deductible. Those are for the kind of attritional losses that it doesn't make sense to, you know how much they're going to be, and you don't want to be pound swapping, so it makes sense to keep those on your own balance sheet. You then have the moderate risk, which is where the captive steps in. Now, the captive retention can be as tall as you want it to be, but the idea is that you have those catastrophe risks being transferred to the traditional insurance markets and the capital market solutions. So that size, that tallness depends on how much risk appetite you have as an organisation. It also depends to a certain extent on the needs of the organisation at that point in time, and in particular around the market conditions. So in a hard market, you might look to put more into your captive because the rates and the capacity has shrunk in the external market. So it will vary, and also it will vary depending on the type of risk that you're putting in. So, for example, property is much more volatile than motor, which is much more attritional, and so you need to think about how you're balancing those risks off each other. So moving on to the next slide. So this is a typical fronting for a single parent captive. This is a structure where there is a fronting insurer involved, so that would be like a Zurich. We do see direct, or we don't see direct, but you can have a direct writing where a captive will have a license to write policies. But where you've got multiple territories, you are going to be needing to have someone who can place the local policies, who can service it, who can understand the claims and move premiums around. So it's quite a complex governance landscape, and so fronting insurers have generally put a lot of time and effort into their infrastructure, and that's really what the benefit that they bring. So moving on to a protected cell, I mean, really from a fronting perspective, there's no difference between a single parent and a protected cell from an insurer perspective. You will benefit from a PCC if you have a smaller organisation and your risk is less. But But essentially, it's the same, and it doesn't necessarily impact the fronting structure that you're going to put in place, which I'll talk a bit about in a sec. So moving on to the actual structure itself. So this is a monoline fronting structure. In this example, it is a property line of business, PDBI. There is a limit of 500 million, and the captive is retaining 100% of 10 million with an annual aggregate of 15 million. And you'll see that Zurich retains some risk, and other FAC providers also provide risk. Now, you can consider a gross or a net cession. In both cases, when the aggregate is exhausted, the insurers actually drop down. But in a gross cession, what will happen is Zurich will cede 100% of that 500 million to the captive, and then the captive will purchase their own reinsurance. Now, there are reinsurance arbitrage opportunities there. My screen's just gone off. There are arbitrage opportunities there, but then you have to balance that with solvency requirements, which I'm not going to go into. But where there is a gross cession, a net cession, you would just cede the captive's retention and keep it there. With the gross cession, insurers typically look to retain 5% within that programme, because otherwise we have to deposit account it, and that's a conversation for another time. But it's just something to be aware of, because if you're wanting to retain more risk, then that might be a challenge for you. So, moving on to a multi-line structure. So this is actually completely the same principle, but you can see there's much more lines of business, gross or net. Here you can see there's a single fronting partner. Now, there are some benefits in that the diversification benefits you'll see within the AG mean that the total cost of risk can be reduced and the capital requirements can be reduced for the captive. And in this example as well, we've got life and non-life. We do that in Zurich, and we can actually use the diversification benefits against both and put them on one single reinsurance agreement. Now, you may want to sort of spread your offering around and from a fronting perspective, but you might not necessarily get those diversification benefits if you do that, because the different insurers will want to have their own separate AGs. If you do put all your eggs in one basket, then the thing to consider is around the fronting partner's offering. So that's how are they servicing it locally, and also at a group level. So that's things like policy issuance claims, etc. So this is a sort of typical fronting structure. You have your local policies that will be issued to a good local standard. Then the difference in conditions and difference in limits, or DIC-DIL, is covered under the master policy. Now, where you can, some countries allow you to issue policies or provide insurance services into a country that you don't actually have a policy in, and others don't. So where you can do that, you say that admitted is permitted, and otherwise non-admitted is not permitted. I've got that the wrong way around, haven't I? Anyway, you get the gist. So, but the point there is that if you can't issue services into that country, then you have to cover the difference between the local policy and the overarching master policy under a FINC endorsement, which is basically it reimburses the parent for the loss in the local operation. You try to minimise that, because that will potentially have repatriation challenges around taxes and costs. And also, if you don't have local policies in place, then you could potentially be at risk if you have a loss in that territory and you can't provide services. So if you're not going to have a local policy, which is fine, but you need to consider that, because it might have an impact on fees and that sort of thing. But actually, in the long run, how is your... I can see some smiles there. You can actually... how is the local operation going to service that claim? How are they going to adjust it? And how are they going to finance it? So those are the considerations. So the benefits that a captive can bring in this type of structure are that you can have local bespoke wordings and you can have lower deductibles, lower operating deductibles. Where you have bespoke wordings, just something to consider is that you might need to think about how you're handling claims, so you might want to get a third-party adjuster. The insurer is more likely to put through wordings where there's a captive, with bespoke wordings where there's a captive, because they're not necessarily retaining that risk. But they might not have the ability to handle the claims, so in that case you would use a third-party adjuster. Now, the final point I make on this slide is premium allocations. So you need to be making sure when you're structuring your programme that the local premium is commensurate to the risk, so it reflects the exposure that's actually in the territory. So that is a key point, and I'll touch on it again later. Don't know what's going on down there. So a little bit about premium flows. This is how Zurich is set up. Other companies will have similar types of setup. Effectively, you have the master policy, and if it's issued like here in the UK, for example, you will have a UK premium plus all the Dick Deal and the Fink premiums lumped into one. You'll then have the local offices or partners issuing their local policies, and they will charge a premium directly to the insured. You do have an option in some territories for central, so it just gets added onto that master. But again, the point around the premium allocation being allocated to the exposure that's in that territory is a key point. So we, at Zurich, we pool everything in our clearinghouse, so we have all the local territories channeling their money into our clearinghouse, and then we make a payment to the captive. We can do this in instalments, lump sum, or monthly payments, and other carriers will be able to do similar. There is a credit risk between the policy being issued and the invoice being issued and the premium being collected and being received by the captive. So we actually we pay over the entire lump sum when a certain threshold has been reached. So just making sure that payment is really fast and streamlined. At the end of the day, those premiums are for the captive, so it's quite imperative that you get those as quickly as possible. Just one last thing to point out here is this is a net session. If you had a gross session that I mentioned earlier, and the captive is buying their own reinsurance, then let's see if I can get that one. Oh, wrong way. We'll do this one. That session there would be paid by the captive. So, how do we have time? Cool. So, more about how we, Zurich, as a company, and I mean, other companies will have other carriers will have a similar approach to this, but this is how we approach our fronting for captives. So, effectively, you've got an insurer issuing a policy on behalf of the captive, even though they're retaining the original portion of the risk. You're sort of transferring it from an insurer perspective from being an underwriting risk to a credit risk. So we would then charge a fee for this, but this encompasses local costs, so the cost that the local partner or the local Zurich office has to liaise with the individual operations, local operations, and set that policy up, premium collection, all that sort of thing. And that's very much dependent on the premium and the limits, and actually, sort of, to a certain extent, the amount of work that is needed to service that particular operation. There are also UK costs for setting up the programme, and then the credit risk and cost of collateral, cost of capital. I'll talk a little bit about collateral in my next slide. So I mentioned earlier around validating premiums across the local level. We actually also need to do that at the captive level. So there are two tests that we do, and that's the risk transfer testing and the arm's length pricing. So risk transfer is really around, does the premium reflect, so the risk transfer is basically saying that the premium that's transferred needs to actually make sure that the captive is taking risk. So, you can't just put the ag. So we had an ag of 15 million there. You can't just put 15 mil. You have to take some risk. The arm's length premium is around the BEPS transfer pricing principle, and that's really around, is it a fair market price? So, again, it's got to reflect the exposure, it's got to reflect the risk. So there are various tests that we do around that. And, it is important that we do that right. We're not going to tell you what the premium is, but we can certainly give guidance on where we think it should sit. So, we have in the past been approached by the tax authorities, and so having Zurich as a partner validating those premiums is a real benefit. So I'm just going to talk a little bit about collateral. We talked about credit risk. There is counterparty risk with the captive, and that's very much driven by the parent. Although we do rate the captives, and some of our captives are very large. So we do. It's really around sort of how strategically important is that captive to the parent? Like if it experiences unexpected losses, how is it going to capitalise, or is it going to? So that's quite an important factor for us. And how we measure the risk will depend on the exposure, the tenure, so the tail of the risk. So for example, employer's liability is longer tail and property is shorter tail. With the longer exposures, we tend to take a bit more of a stringent view, and with the shorter tail, it's a bit more flexible. So you can see it falls into two buckets there. You've got your collateral, so your hard collateral, which is letters of credit, which is by far the most common. Although some of our captives are publicly rated better than some of the banks, so it doesn't always make sense to ask for an LOC. And we've seen sort of a drop-off on surety bonds. But interestingly, the security interest and trust agreements are rising in popularity. So that's something that we've seen from a Zurich perspective. The other aspect is the mitigant. So this is parental guarantee. From a Zurich perspective, it's great because it's the parents basically vouching for the captive, but possibly not as keen from a parent perspective because of the transfer pricing principles. Then we've got some mitigants that we put in a clause. In the reinsurance agreement, so they are triggered and we might ask for collateral. So, it might not necessarily have an impact right now, but actually down the line, if the financial position deteriorates, then it could potentially mean that we ask for collateral. How we do that, obviously, how we collateralise, we can be flexible, we can take a blended approach, but it does mean that the credit risk will be, the cost of capital and the credit risk premiums will be based on that structure. So there'll be a few options there. And the final slide I'm going to look at is just a really, really quick point, really. So I kind of mentioned it earlier around, if you are going to go to a fronting insurer for, all of your lines of business, then, you need to make sure that service is right. And the data is, I'm not going to go through all the list on the right, but that's the sort of thing you need to be considering when you're choosing a fronting partner. You've got to be able to get hold of your data, your policies, and your bordereaux when you need them. And so, it's a bit more holistic than just issuing policies at a local level. So that's pretty much everything I wanted to talk about. I'll just sort of close before I sort of open for questions to say, look, it's really up to you how you structure your captive. There will be pros and cons for different types of structures, costs associated with it. It will depend on your risk appetite, and also the business needs now and in the future. So the key to success here is to talk to your broker, to work closely with them, your captive manager, your consultants, as well as your insurer to put in place your programme. So with that, I'll open for questions if you have any. None? Okay.
So Emma, sorry, I didn't catch all of the presentation, so forgive me if I missed this. Is it quite common if you've got a captive doing an international programme that you have more than one fronting partner across the network? So will you be on programme where there's other fronters are also writing across that programme?
Yeah, so we would have potential. Well, I mean, one of the Zurich proposition is that you can do all of that for you. But yeah, it's quite common for customers to go to different fronting carriers for different line of businesses. And you see it on the life side as well. They'll approach different networks. So I mean, if you do that, then you can look at structuring aggregate protection across the back rather than sort of to still reap those benefits of diversification. But yeah, typically you do see that quite a lot, and you might not put all your lines into the captive anyway. So, right. And over to Peter. Thank you. Oh, sorry.
Would you have to, so if you had a kind of a multinational program, would you have to have all of your local jurisdictions fronted, or can you kind of slice and dice? So let's say, for example, it's professional indemnity, and so you haven't got the kind of requirement to have kind of locally admitted cover.
Yeah, absolutely.
But you want it because, let's say, for example, in certain jurisdictions, you've got an obligation to your clients, or your clients are kind of specific about the way that they kind of want the cover evidenced.
Yeah.
And so you need to put a fronting arrangement in place.
Yeah.
Can you kind of slice and dice it? So
yeah, pretty much. I mean, again, it depends on the licenses and the service capability of your fronting partner, but I think typically on things like cyber, you might not necessarily have that many local policies and things like that, but you could, as long as you've got like at Zurich we've got quite a stringent process of onboarding local partners, and if we really needed one in that territory or we didn't have one, then you could consider it. So yes, is the answer to that. It really depends on what your needs are, and quite often we're asked to front for captives that need to have paper, where it's normally a direct writing captive, and they need to have paper evidence from an insurer such as Zurich. So, yeah.
Thank you.
All right. Any more for anyone? Cool.